In the span of 48 hours, the silver market moved like a trap door opened beneath it. Not a slow grind, not a polite correction. A sudden mechanical repricing that looked irrational on the chart until you track what actually changed underneath. At the exact moment Western futures were being forced to delever, Shanghai was still paying up for real metal, with physical premiums reported around $8 an ounce. Think about that. A market showing scarcity in the East while the paper price is getting slammed in the West. And here's the part that breaks normal expectations. A single contract on the main U.S. futures venue represents 5,000 ounces of silver. When the collateral required to hold that contract jumps by thousands of dollars almost overnight, it doesn't matter what your thesis is. It doesn't matter what your spreadsheet says. You either post more cash or you sell. That's not opinion. That's the rulebook. In late December 2025, reports circulated that the initial margin on the March 2026 silver futures contract rose from roughly $22,000 to roughly $25,000 per contract, a jump of about 14%. That is a sudden increase in the price of leverage, and when leverage is the fuel, raising the fuel cost mid-flight changes everything. They said this kind of break couldn't happen in a modern liquid market. They said the depth is too large, the participants too sophisticated, the arbitrage too efficient. Yet, in days, not months, the tape printed moves that looked like panic, even while physical premiums suggested tightness elsewhere. Institutions already understand this dynamic because they live inside it. The setup is the real story. What I'm about to reveal changes how you read the next move, because the market didn't just reprice on emotion. It repriced on plumbing. It repriced on collateral. It repriced on the invisible hand of margin. Welcome to Signal and Structure. This is where we decode what matters before it becomes consensus. We're not here to shout at candles. We're here to follow the incentives, the mechanics, and the contradictions that the chart alone can't explain. If you've been listening to markets long enough, you know the value of a calm voice that points to the data when everyone else points to the drama. And if you're new, you're in the right place. Drop a comment with where you're watching from, because this market is global now, and the dislocation we're tracking is literally east versus west. Now let's reconstruct the event with forensic detail, because the sequence matters. Into late 2025, silver was already volatile. Crowded positioning tends to build when a narrative catches fire. Inflation hedges, industrial demand, energy transition, monetary hedging, and increasingly China-led speculative waves. When price accelerates, the market's natural reflex is to lever up, because the fastest way to participate is through futures. That's how liquidity is manufactured. But that is also how fragility is manufactured. Then the margin lever got pulled. The exact day is important. December 29th, 2025 is when the broader market narrative crystallized around CME pressure, because that's when traders were forced to reconcile a price move with an institutional constraint. A margin requirement is not a comment on direction. It's a comment on volatility and risk. But functionally, it acts like a governor on leverage. Raise it, and the market's effective buying power shrinks instantly. If you're a fund holding thousands of contracts, you don't just find a few extra dollars. You find millions. If you're a dealer running a book that nets exposures across clients, you suddenly have to allocate balance sheet differently. If you're a smaller participant, you don't get a meeting, you get a margin call. And margin calls create selling pressure regardless of whether the underlying story is bullish, bearish, or confused. This is where the central mystery appears. Why would silver get hit hard on Western futures screens while reports highlighted strong physical demand signals in Asia? Why would Shanghai be paying a premium while US futures were being hammered? In a textbook, the premium should invite arbitrage. Buy the cheap market, sell the expensive one, deliver, and capture the spread. In reality, the arbitrage is constrained by transport, financing, vaulting, and most importantly, the same collateral mechanics we're talking about. When that spread exists and persists, it's not a trivia question, it's a stress test. It's the market admitting that the one price theory has limits. If you've been around long enough, you've seen this playbook before. Markets don't usually break because everyone suddenly changes their mind. They break because constraints tighten at the worst possible moment. In 1980, silver's famous blow-off and collapse was not just about exuberance. It was about the tightening of rules, the raising of margins, and the forced liquidation of leveraged positions. Price didn't drift down gently. It snapped. In 2011, silver again ran hard and then reversed violently after margin requirements were raised multiple times in quick succession. The narrative at the time was simple. Too much speculation, too much froth. But beneath that narrative was a mechanical reality. Increasing the cost to carry leveraged longs forced a cascade of selling. The market was not debunking the bull thesis in a philosophical sense. It was liquidating the structure that expressed it. And in 2025 into early 2026, the pattern reappears with a modern twist. The modern twist is geography. Shanghai can be tight while Chicago is delevering. Those can be true at the same time, temporarily. The longer they stay true together, the more violent the eventual reconciliation tends to be. So who are the players and what exactly did they do? Start with the exchange. The CME group is not a trader taking a directional view. It is a risk manager for a marketplace. Its job is to keep the clearing system stable. Stability comes from performance bonds, also known as margins. When volatility rises, margins rise. When margins rise, leverage falls. When leverage falls quickly, price can move violently. That chain is not political, not conspiratorial, not mystical. It is how derivatives plumbing works. Now layer in a second institutional move that matters. In January 2026, CME shifted precious metals performance bond calculations toward a percentage of notional methodology. That sounds technical, but the implication is intuitive. If margin is linked more directly to the notional value of the contract, then as price rises, the required collateral rises more automatically. That means the market's leverage is squeezed precisely when price is rising, which can dampen runaway moves but can also amplify reversals if participants are already stretched. Next, consider the ecosystem around the exchange. Brokers, clearing members, banks, and large funds. Clearing members are on the hook to the clearinghouse. They care less about your conviction and more about your collateral. When margins rise, their internal risk systems often become tighter too. They can raise house margins above exchange minimums. They can reduce credit lines. They can demand more cash. Again, none of this requires anyone to predict silver. It requires them to manage risk. Now add the East. The Shanghai market, through its physical orientation and local demand dynamics, can reflect immediate scarcity premiums that futures markets can temporarily ignore. Premiums around $7 to $8 per ounce, as widely discussed in early 2026 commentary, are not normal in a well-arbitraged world. Even a $1 premium draws attention. A premium that large signals something is binding. Available inventory, delivery timelines, funding constraints, or a surge in local demand. This is the dislocation, and it's where it gets interesting. On one side, you have a highly liquid futures complex where the marginal participant often uses leverage. On the other side, you have buyers of physical metal often with different motivations and different constraints. The futures market can move the headline price quickly because paper is fast. Physical markets move slower because atoms are slow. But physical markets can reveal stress earlier because real supply chains can't be conjured by a market order. So let's put the contradiction into one sentence. Western paper prices were forced lower by rising collateral demands and liquidation, while Eastern physical prices were supported by premiums that implied scarcity or urgency. Those are opposite messages. They cannot both persist indefinitely without a reconciliation mechanism. Here is the evidence, with numbers that anchor the story. First, the reported jump from about $22,000 to about $25,000 in initial margin for the March 2026 silver futures contract. That's roughly $3,000 more collateral per contract. If you're holding one contract, it's annoying. If you're holding 1,000 contracts, it's $3 million immediately. If you're holding 5,000 contracts, it's $15 million. That's just initial margin before you even talk about mark-to-market losses. Second, the premium itself. A physical premium of around $8 an ounce on a commodity that might be trading around the tens or low hundreds depending on the period is a meaningful percentage. It's the market charging a toll for immediacy. Third, the behavioral signature of forced selling. Forced selling doesn't look like a thoughtful reallocation. It looks like the same direction across many instruments at once. It looks like sharp intraday drops, failed rebounds, and volatility spikes. It looks like correlation rising because participants are selling what they can, not what they want. Now, let's explain the mechanism in plain language. Imagine a crowded theater where everyone is leaning forward to see the stage. It works as long as no one pushes. Now imagine the floor suddenly tilts. People don't calmly decide to step back. They stumble. Some fall. The exit becomes a bottleneck. That's what a margin hike does to a leveraged trade. It tilts the floor. When the floor tilts, the first wave is margin calls. Those margin calls force liquidations. Those liquidations push price down, which creates more variation margin, which creates more margin calls. That is the feedback loop. And because futures are marked to market daily, sometimes intraday, the loop can tighten quickly. If the market is thin at the margin, the loop accelerates. If liquidity providers step back because volatility is high, it accelerates further. Now fold in this percentage of notional idea. If the system is designed so that higher prices automatically demand higher collateral, the market's ability to sustain a parabolic move is limited. But if the move has already happened and collateral requirements rise into it, the unwind can be even more abrupt because the same participants who pushed price up are suddenly unable to finance their positions at the new requirement. This is not a moral story about speculation. It's a structural story about how leverage interacts with rules. So what does all of this mean going forward, and why does it set up what many describe as a violent reprice? A violent reprice is what happens when two incompatible truths collide. The first truth is physical. Premiums and demand in one region are signaling tightness. The second truth is financial. Collateral requirements and risk management are forcing paper positions to shrink. One is slow and real, the other is fast and mechanical. The collision point is where the market has to choose which truth dominates the reference price. Historically, when a physical premium persists while paper gets hit by mechanical selling, the next phase is often one of two outcomes. Either the paper market eventually rebounds as the forced selling exhausts and physical tightness reasserts itself through flows, or the physical premium collapses because supply loosens, demand cools, or financing constraints are relieved. The key is that the spread between them is unstable. It tends to resolve, not drift. There are three scenarios to watch, framed as patterns, not predictions. In the conservative scenario, margins stay elevated, volatility cools, and the premium gradually compresses as logistics and inventory adjust. That's the market healing. In the moderate scenario, the premium stays stubborn, paper volatility remains high, and the market oscillates violently as leverage rebuilds and is repeatedly squeezed. That's a churn regime where the headline price stops being a clean signal of underlying conditions. In the aggressive scenario, the dislocation widens to the point that some participants are forced to choose between honoring physical demand at higher local prices or stepping back from providing liquidity on the paper side. And that's when repricing can become sudden, gapping, and psychologically shocking. What should you watch to know which path the market is taking? Not opinions? Indicators? Watch margin notices and performance bond changes. Watch whether volatility is staying high enough to justify continued margin pressure. Watch the persistence and size of Shanghai premiums. Watch whether the premium widens during paper sell-offs, because that would suggest physical is not following paper down. Watch deliverability signals, inventory changes, delivery demands, and the tone of market commentary from the institutions that actually have to make settlement work. Let's slow down and make the Shanghai premium concrete, because premiums are easy to dismiss until you translate them into behavior. A premium is not a theory, it's a receipt. It means buyers are paying above a reference price to secure immediate or reliable supply in a specific location. That can happen for benign reasons, like a temporary logistics bottleneck. It can also happen for more structural reasons, like inventory being tied up, import constraints, or a sudden wave of demand that local stock can't satisfy fast enough. When the premium becomes large and persistent, it's telling you that price is doing two jobs at once. It's clearing paper risk in one venue and clearing physical scarcity in another. Now compare that to what a futures price is. A futures price is a financial consensus for delivery at a future date, in a standardized form, at a specific venue, under a specific rulebook. In theory, futures and spot converge through arbitrage. In practice, the bridge between them is built out of financing, shipping, vaulting, insurance, and credit. When one of those beams weakens, the bridge doesn't collapse gracefully. It starts to sway. That sway is what you see as a dislocation. This is why the phrase paper versus physical is not a slogan here. It's a description of two separate constraint sets. Physical buyers care about availability, timing, purity, and local settlement. Paper participants care about collateral, volatility, and roll costs. When the price is calm, those worlds line up. When the price gets wild, those worlds separate, and the gap itself becomes information. Now, about the China speculation label that often gets attached to these moves. It's not wrong that speculative behavior can amplify volatility, but it's incomplete. Speculation is not a unique feature of one country. It's a feature of markets whenever leverage is available and narratives are strong. What's unique here is that China's physical and regional pricing can transmit a different signal than Western paper screens, and the global market has to reconcile them. That reconciliation is the repricing. This is also why exchange actions feel like a plot twist to casual observers. An exchange doesn't wait for your narrative to conclude. It reacts to realized volatility and perceived risk. When realized volatility spikes, the clearinghouse raises the performance bond to protect itself. That is rational for the system, but it can be brutal for positions. It is the difference between price can move and price must move because participants are compelled to act. If you want an analogy that lands, think of margin as the size of the shock absorber on a vehicle. When the road is smooth, small shocks don't matter. When the road becomes potholes and speed bumps, a larger shock absorber keeps the vehicle from bottoming out. The problem is, installing a larger shock absorber while you're already driving changes the ride immediately. If you are relying on a tight, cheap suspension to go fast, you can't go fast the same way anymore. That's leverage under higher margin. And that is where institutional movement becomes visible without needing to name every fund. You can often infer who is in control by watching the conditions under which price moves. When the market rallies on thin volume but margins rise, the rally may be fragile. When the market sells off but physical premiums don't collapse, the sell-off may be mechanical. When the market whipsaws around margin events, it's telling you the marginal participant is constrained by the rulebook. So when people say violent reprice, they're not just trying to be dramatic. They're describing what happens when the marginal participant changes. If the marginal participant is a leveraged speculator and collateral rises, the marginal participant becomes a forced seller. That's violent. If the marginal participant becomes a physical buyer, stepping in when paper is liquidating, the turn can be violent in the other direction. What matters is not the story you prefer. What matters is which participant is setting the next print. There's one more layer: time. Futures markets compress time because positions are marked continuously. Physical markets expand time because moving metal takes time. Dislocations are, in a sense, the market's way of expressing a time mismatch. The premium is a price for immediacy. The margin hike is a price for risk. When immediacy becomes expensive in one place and risk becomes expensive in another, the market is charging two different tolls at once. That's when repricing tends to be sharp, because participants are constantly forced to translate one toll into the other. Now, there's a deeper point here that most people miss. The big divide in markets is not intelligence, it's attention to structure. People who only watch price will always be late to structural shifts. People who watch the constraints will often see the move before the move. Institutions move first because they are closest to the plumbing. They see collateral changes, they see clearing constraints, they see funding costs, they see where liquidity is thinning. Retail moves last because retail has shown the chart after the mechanics have already acted. That gap is not a conspiracy. It's the natural result of information proximity. And that's why this particular setup matters. Shanghai premiums are a physical signal. CME margin pressure is a structural signal. When physical and structural signals collide, the price action becomes a referendum on constraints, not a referendum on narratives. If the physical signal remains firm, the paper market can only ignore it for so long before flows and arbitrage attempts increase. If the structural signal remains tight, the paper market can suppress price spikes by making leverage expensive. The tension between those forces is what produces the kind of moves that feel impossible after the fact. The market is essentially asking one question: how much leverage can this story support, and how much physical metal is actually available where demand is expressing itself? Those are the two axes of repricing. This is the part no one is discussing enough. The most dramatic moves often happen after the headline event, not during it. The first margin hike creates the initial break. Then participants adapt. They reduce size. They change strategies. They shift venues. They hedge differently. The system stabilizes. And then when conditions appear calm, a second order effect triggers the next wave. If you step back, the pattern is clear across decades. In 1980, a crowded silver trade met tightening rules and reversed violently. In 2011, a crowded silver trade met rising margins and reversed violently. In 2025 into 2026, a crowded silver environment met collateral shocks and a geography-based premium signal, and volatility surged. Different era, same lever. So the choice ahead is simple. You can treat these moves as random, as if the market is just a mood ring. Or you can treat them as a mechanical system, where inputs produce outputs, and where dislocations are clues. The people who see the system will understand why the next repricing can be sudden. Signal and structure is where we decode what matters before its headlines. If this connected dots you hadn't lined up yet, you know what to do. Because the question isn't whether markets reprice. Markets always reprice. The question is whether you recognize the setup before the repricing forces everyone else to. And that's why this moment matters. Fault lines are visible, prices, premiums, rule changes. Track them and you won't need headline to know a break is forming.